The last option is really what we call alternative funding sources. Now these become a bit more creative, so moving away from sort of like the traditional funding structures. So with streaming, what happens is that an institutional investor provides a payment to a mine, and on the basis of that payment, the mine, once it starts production, will be selling all of their production, all the commodity, all of their output to the institutional investor at a discount. So this is what we call a non-dilution structure, in the sense that the institutional investor is actually not getting any equity in the project, but they are really looking at a ring-fence structure that ensures that they get access to the commodity. The disadvantage of this structure is that because those cash flows, or because that commodity is then committed to the institutional investor, it then limits the SPV or the entity's ability to go and raise additional debt. The second structure under the alternative financing options is what they call a royalty. So with a royalty, it's basically an upfront payment for the agreement that in the future, the entity, the mine, the SPV, will be paying a certain amount to the investor. And this can be based on revenue, it can be based on profit, it can be based on net smelter return, it can be based on production. So just to give you an example, I'm sure you're aware of a transaction that was done between ZCCM and Kansanshi. So ZCCM used to own 20% of Kansanshi. They entered into this royalty agreement where over the life of Kansanshi, instead of ZCCM receiving any dividends from that investment, they would then be paid 3.1% of Kansanshi's revenue. So those are the kind of funding structures that enable, so in this instance, it enabled or facilitated the purchase of ZCCM's stake in Kansanshi in exchange for the royalty payments that would accrue to them over the life of the mine. And then the last one is what they call an offtake financing agreement.